Well, if you've looked at enough income statements, you might have come across something called an extraordinary item. And you might be wondering, well, what is this? What is so extraordinary about it? Well, an extraordinary item is essentially a gain or loss that has two critical properties. And those properties are this. So, first of all, it's unusual in nature. It's not something that you would normally think that would be associated with your business's operations. For example, a volcano erupting and just wiping out one of your manufacturing plants. That's something unusual. That's not really related to your business, and it's not really something. It's kind of this freak event that you really didn't see coming in. So we can say that's unusual. But it has to not just be an unusual event. It also has to have the second property, which is that it has to be infrequent in occurrence. So infrequent in occurrence is key. Now we have to have both. Okay, now here's the reason. So you might say, well, you know what? We have this terrible storm with this hail damage. So let's say you had some just awful hail damage. But now we have to ask, how frequent is that hail damage? Now, has this happened 3 years ago? If a similar storm happened 3 years ago, or it happens every 10 years, well, then we say, well, maybe that's not so infrequent. Maybe that's not infrequent at all. So then that's not extraordinary. We can't say that's an extraordinary item. It has to be unusual, and not just something that happens in normal business operations, but also something that doesn't happen often. So a good example of something that kind of is kind of unusual, but is not infrequent and doesn't fall under this is so when we think of like growing crops, like kind of like a freeze on crops in Florida. So you have a crop freeze, or you have this kind of early frost or something in Florida. Well, the thing is that might happen every 4 or 5 years. It's not something that happens every year, but it's unusual. I mean, we don't expect it, but it does happen frequently enough that we can't say that it's so. This is not infrequent. So when we have to meet both tests here, need to meet both of these criteria in order for this to be an extraordinary item. So an extraordinary item, you can see already this involves a little bit of discretion in determining what's extraordinary, what's not. Extraordinary items are rarely reported on income statement. I mean, this is something that isn't on every firm's income statement. Maybe less than 1% of firms or something are actually reporting an extraordinary item. So it might be best, that being the case, to say, well, what is not an extraordinary item? And so we can think of some examples here, other than just this freezing of some of the citrus crops. So when we think of not extraordinary, we can think of normal write-downs of inventory and receivables. So if you had, let's say you make computers and they come out with a new kind of computer, and now you've got some like obsolescence. So the computers that you made are obsolete because your competitor came out with some new ones, and so now your goods, we have to take an inventory write-down. That's not extraordinary, right? Because we expect that there might be some obsolescence in your business, or these kind of write-downs. We expect these things that happen in business operations. Even if you're surprised, we expect that they would happen in normal business operations. And similarly, disposals of property, plant, and equipment. If you say, well, I didn't think I was going to sell that machine, or I didn't think the machine was going to break down. Well, it's just property, plant, and equipment. We know that there will be problems, or that we might do things that we didn't expect to do with that equipment. That does not mean it's an extraordinary item. So now there's kind of exceptions though. But what if there's some kind of major casualty from that volcano or from an earthquake? Well, now we can say, okay, now this is meeting this test of it's an unusual thing and it's infrequent. So we can say now, if there's some kind of major casualty, then we can say that these things can actually go ahead and be a part of an extraordinary item loss. So bear that in mind. But what the goal is to understand that if you buy a machine and then the machine breaks or something, that is not going to be an extraordinary item. And if your inventory declines in value, That's just a loss. That's not an extraordinary loss. So now another thing is this foreign currency devaluations. So if you have a lot of contracts that are denominated in foreign currencies and you didn't hedge those contracts and there's some kind of major devaluation, then that's not going to be an extraordinary item. So that's just a loss on a foreign currency thing. Now if there's some kind of problem in a foreign country and you have some kind of maybe there's an expropriation of some. Now this doesn't necessarily deal with devaluations, but some kind of expropriation of assets from your firm, for example, property, plant, and equipment. Now then that kind of foreign that kind of thing can lead to an extraordinary item. But just the currency just being devalued due to some political instability or something, that is not an extraordinary item. And if your workers go on strike, that is not an extraordinary item either. So just bear in mind, an extraordinary item is something that is just very rarely recognized in practice, but when it is recognized, it's just a gain or loss that's unusual in nature, infrequent in occurrence, and you'll see it at the bottom of the income statement.